Hello and welcome to the Crypto Beat, episode 4. We're going to discuss right now what's happening in the crypto space. As always, my name is Tim Copeland. I'm the editor-in-chief of The Block, crypto native news site. Joining me today, we have Michael Bentley, co-founder and CEO of Euler Labs. Welcome to. I got it wrong. I knew I would. Euler. We had a chat about this beforehand. Euler Labs. Welcome to the
No,
show. How are we doing?
you. I think you said it right. You said Euler, right?
I did. I did first time.
Yeah, Euler. You got it right first time. Yeah, and I'm good, thanks. You? How are you doing?
Doing well, thanks. So people say Euler when they get it wrong, right?
So people say Euler or Euler, and the correct one is Euler. Yeah, we're named after this very famous Swiss mathematician who's yeah, died 200 years ago, and he was famous among lots of things for studying this compound interest rate formula. And so when I was first creating the project 4 years ago, when it was just a hackathon project essentially, I named it after this Swiss mathematician who was interested in compound interest because I thought that was kind of a cool connect to a lending and borrowing platform. And so that's the origin story for the name.
Awesome. Now, before we get started, I'd like to mention the block is hosting its first ever crypto conference this year with some of crypto's biggest names. Head to emergence.xyz and use the code TheCryptoBeat, all one word, all lowercase, for 20% off. Now, today we are going to focus on Euler's V2 launch. Very exciting. But first, we have a little bit of breaking news that happened about five minutes ago. So we're pretty fresh to the scene. We just saw that the CFTC has settled charges with Uniswap for effectively offering derivatives through the trading of leveraged tokens. Uniswap Labs has paid a 175K fine. Michael, how big of a deal is this?
Yeah, I mean it's kind of tricky without getting a chance to read the full notice and everything, but just my initial reaction, it sounds like not that big of a deal. I think it probably comes as no surprise that they were told not to issue certain tokens on their website some time ago. I mean, I remember a few years ago there's suddenly a big change in the kinds of things that the website would display and so on. So I think it's not that big of a surprise for people that yeah, that they were told some time ago that certain tokens with certain properties shouldn't be displayed to users in the US.
Cool. Thank you. Now, yeah, we're going to go straight into Euler V2. You announced the launch of it today. How does it feel to finally have it live?
It's a mix of emotions. It's exciting, a little bit scary. Yeah, I'm filled with optimism. And I'm very tired because the last few weeks have been a lot of hard work. Getting up to launch, there's always so much to do. So yeah, I feel a whole mix of emotions, but overall, really, really glad to be back. It's felt kind of painful being out of the scene for so long now. It's been well over a year, and yeah, it's been just sort of watching from the sidelines. Really, you feel like a kind of you've been sat on the substitutes bench, and now we're back in the game. And yeah, it's great to have Euler back.
For sure. And for anyone who's joined the industry recently or just doesn't happen to know, what's the backstory? Why were you out of the game?
Yeah, an unfortunate incident back in 2023, in March 2023. So Euler had been live for around a year and a half, and was I think the third largest lending protocol in Ethereum, and was growing quite rapidly. And a bug was exploited by somebody and drained the protocol of $200 million. Uh, over a set period of several weeks, we then recovered the funds. We tracked down the user and were able to make users whole, recovering 100% of the funds. But yeah, essentially that killed Euler V1. It was a very, very difficult period for everybody involved, for all the users, also for our team. It happened 4 days after my son was born. So it was an especially difficult period. It was the same weekend that USDC had depegged, and there was all sorts of trouble with banking in the US. So it was just overall a horrific time, and one of those things that we're glad to leave behind us. Yeah.
Okay, and if you like recovered all the funds, why didn't you simply just sort of like patch the bug and relaunch as is?
Yeah, it's a good question. I mean, a few reasons really. The the context here, the fix would have actually been a single line of code. The bug that led to the exploit was actually a patch from a much smaller bug that was relayed to the team more than a year earlier. And so it turns out that the bug fixed this much smaller big bug, introduced a much larger one. Obviously, it was all audited, including the patch, but things happen, right? Afterwards, I think as a team, we needed some time to digest everything. Just fixing it and relaunching didn't feel right. There were things about the protocol that we weren't happy with anyway, completely unrelated to security, but just when you launch a first product, you realize that there are things about it that you don't like, and how it gets received by the industry is things change, right? And there were lots of things about Euler V1 that were really good, and it was a much loved product, but the things about it as well that I think that weren't as successful as we were hoping. And so we had this choice, right? Do we just patch this and release a product that we weren't 100% happy with, or do we start from fresh and build exactly what we want? And so that's what we decided to do. It probably took a little bit longer than we were anticipating when we started building again back in it must have been sort of June time of 2023. But we're extremely proud of what we've built, and very pleased to finally ship it out.
Awesome. So what's the elevator pitch?
So it's lots of lending protocols. They let users lend and borrow digital assets. Most of them are products. They're designed with particular target user in mind. Euler is more of a developer's kit that lets builders build their own lending protocols, and that means that you can come in and build something very simple. If that's just a single pair of collateral and borrowable assets, all the way up to a large monolithic complex lending product like Aave. You can deploy your own lending protocols from Aave all the way down to a simple pair and anything in between, and then you can connect them to one another. And that can all be done in a permissionless fashion by builders. And what this means for end users is that they get access to a huge range of lending and borrowing opportunities that just don't exist on the market today. So It's a really powerful, developers primitive that's going to open up whole new avenues and markets, I think.
Sure. And if you have like developers building their own products sort of based on the protocol, how do you know that they'll use like the Euler token, or will they not?
Good question. Well, the Euler token plays a role in several different roles in the Euler ecosystem. Firstly, it's a governance token with the Euler DAO. So any parameters that can be changed or influence the way that the protocol works, Euler gives people voting rights over those kind of changes. But with the V2, we've changed the utility of the token as well. It now plays a role in how fees are generated and distributed within the ecosystem. So with V2, people can deploy their own mini lending protocols, and those mini lending protocols accumulate fees. And what happens with those fees is you've got fees now coming in potentially hundreds of different assets. And in an ordinary business, no ordinary business would hold hundreds of different assets on its balance sheet, right? It would usually convert them into a single underlying asset like dollars or pounds or whatever. And in the case of Euler, the token acts as a utility token in an auction. So you can use the Euler token to essentially bid and buy back fees from all of these different pools that have been created by other users out there. So the pools generate fees, and you use the Euler token to essentially buy back those fees from the market. And that's one of the key roles that the Euler token plays in V2, that it didn't really have that kind of utility in V1, where it was more just about governance, really.
Yeah, okay. And one of the big changes between the old Euler and the new Euler appears to be that of modularity. Now, normally we sort of understand this when it comes to like data availability for layer 2s, that kind of thing. What does modularity mean like in this context?
Yeah, I mean, modules are simple things that do, just a few things really well. And the simplest possible thing you can do in a lending protocol is have a pair of assets, one thing that's used as collateral, another asset that you're borrowing from. So the simplest possible lending protocol is just a pair, a collateral liability pair. And in Euler, those are vaults. So users deposit the thing that they're lending into a vault, and they deposit their collateral into a vault. Those vaults form part of a kit, which is it's a module. Like the ability to build vaults itself is a module, and then there are additional modules and protocols that allow users to then connect vaults to one another. And then there are additional modules which allow fees to be distributed from within the system, and there are additional models that allow oracles to interact with the system, and rewards and so on. So it's the whole thing is a developer's kit, and you can compose different modules from within the kit in different ways to create different end products, essentially. So what we've tried to do is abstract all the properties that you get from a lending protocol like Aave, boil them down into their simplest possible components, then allow people to rebuild those in different ways and in ways that they see fit. And the kit as a whole is completely agnostic about lots of things that are normally part of an opinionated product. So like, is a vault governed or not governed? That's completely optional for the vault creator. What type of oracle does it use? What type of loan to value risk parameters are used? These are all flexible and up to the vault creators to choose it, which means that they can piece these modules together, come up with all sorts of different products, and they can all offer a massive variety of different risk reward opportunities for people out there. They can create markets for assets that aren't serviced by the main lending protocols today. They can create new markets that are serviced, but just don't service the particular needs of certain users. So people might want really low risk, at risk isolated lending market for key assets. They might want really high risk, high leverage market. So anything's possible really. And that's the benefit of modularity, is you have these simple components and you compose them in all sorts of different ways.
Okay, and will Euler be launching its own platform at all, like, built on this, or will it purely be relying on other developers to sort of build front ends?
It's a mix of both, really. I mean, the DAO voted to create a few individual markets on Euler at launch. So the initial Euler markets that are supported are actually 8 vaults. There are USDC, USDT, Wrap Stake Teeth, and ETH. And then there are 2 different types of both of those assets, and they're all connected to one another. So those are the base markets. Now, the nice thing about Euler is that when these vaults are being created, any other vault creator, when they're deploying their vault, can opt to use pre-existing vaults as collateral. So, Tim, if you wanted to create, a block vault, vault for block tokens, you could choose to create that vault, deploy it permissionlessly, choose your oracles, your risk preferences, and so on, and then you choose to accept the Euler vaults as collateral. So the initial set of vaults that the DAO have deployed are deliberately chosen to be low risk and kind of short tail assets that lots of people are likely to want to accept as collateral for their vaults. And now we're already seeing, even today, and just since the announcement, we're starting to see vault creators themselves come out and deploy all sorts of different types of vaults and start to accept our vaults as collateral. And I think what we'll see over time is that these new vaults, other vault creators will come on in the future and accept those as collateral, and you get this big network of sort of runaway growth effect where the more deposits a vault gets, the more useful it is as collateral for other vaults, and therefore the more it gets accepted as collateral, which means it gets more deposits. And so the whole ecosystem is designed to have these massive growth and network effects.
Okay, and when you've got like all of these sort of vaults and they're sort of collateralized by like each other, and you have sort of like all these different layers of complexity, where like if you're investing sort of in one, you might end up with sort of exposure to another. Like, is there a risk of sort of systemic issues amongst this that is sort of hard to see because you're like, well, this is collateralized by something else, it's collateralized by something else, and at some point there's like a weak link?
Yeah, that's always the case with networks, and that's true of the like global financial system, right? I think people say no one person understands the global financial system because of all these like dependencies. It's very hard to trace that graph once it exists. So you can't stop that complexity happening anyway, because it naturally happens between different protocols, whether or not it's internal to the protocol or between different protocols. The complexity exists, and it exists because users want that complexity. There's a market for it, essentially. And so the best thing you can do if it's going to exist anyway is to make sure that the modules within those markets are well configured to work with one another, and that to the extent that it's possible that complexity can be made transparent. So it's definitely the case that if your vault accepts lots of other vaults as collateral and they accept lots of other vaults as collateral, you have nested complexity, which users need to be aware of. One of the things we've used on the website is essentially a smart contract which verifies the properties of different vaults. We call it a perspective. And essentially, if you say, I only want to use vaults that have direct exposure to one layer of collateral, or only USDC collateral or something, you can verify through smart contract that the vaults that you're using only have that level of exposure. Now, if you want to take on more risk, you can relax those parameters, you can adapt them, you can do lots of manipulations in order to get just the kinds of markets that you're happy to see.
Okay. And what do you think are the biggest risks that it faces as a whole?
I mean, there's all sorts of risks with DeFi, as we know. The smart contract risk, of course, we'll talk about that, I'm sure, about all the security steps and things we've taken. I think economic risk really depends on what types of markets you're involved in, and usually economic risk, I mean, in the case of a lending protocol, it comes from when you're lending to a market which generates bad debt. Somebody borrowing from the market fails to repay a loan. I think those risks are usually compensated with corresponding rewards, and so you can't talk about risk without reward, and it's up to users to determine what's the right level of risk reward for them. Some users are relatively passive and want to depend on risk managers, and in Euler you can have governed vaults which have a well-defined risk manager whose role it is to essentially manage risk on the protocol for them, and that means lenders can deposit into those vaults and go, well, if I trust this risk manager, I'm trusting them to make good decisions for the vault, to adapt the vault and its risk parameters as the economic environment shifts. Some users like to manage their own risk. They don't want to trust some risk manager out there that they've never met before, right? And they feel more proficient to be able to take on the role of managing their own risk. In Euler, that we have ungoverned vaults as well that users can deploy. And in an ungoverned vault, essentially the risk parameters are fixed, which means obviously the vault won't change as the economic conditions change, but it does mean that users can then rely on those vaults to stay steadfast in a changing environment, and they can manage their own risk by deploying into and out of those vaults over time. So there are lots of different types of risks in lending and borrowing. That's true in DeFi as well as traditional finance, but there are also lots of mechanisms within Euler to allow users to choose a level of risk that they're comfortable with and a type of risk management that they're happy with.
Yeah, for sure. How many vaults do you anticipate there being in like 6 months' time?
It depends how the market reacts. I think we've already seen tens of vaults deployed, today. So we could be looking at hundreds, perhaps. To be honest, people talk about like liquidity fragmentation. I wrote a blog post about this recently. Like, is there concerns about liquidity fragmentation? People say this about Uniswap V4 as well. On Uniswap V4, there'll be lots of different markets for a particular pair, right? And will that just fragment liquidity and make DeFi less usable? And I just don't think that ever really happens in practice. And that's because once a pool that has a certain parameterization that's useful, that people find useful, accrues liquidity, then people tend to use that pool in preference to similar pools which don't have liquidity. So it's true that liquidity can fragment into different pools that have different properties, and I think that's perfectly healthy and normal. But it's kind of generally not true that liquidity just arbitrarily fragments. It almost always goes into a place where people find it useful. So I think the number of vaults is not necessarily a useful statistic in the same way that the number of pairs that have been deployed on Uniswap is not a great statistic. I think that's in the tens or hundreds of thousands now for Uniswap V2. But really, there's probably only a few hundred really active markets, right? And I think the same will happen with Euler, that there will be sort of Schelling points or kind of standard vault configurations that people find useful. Like, I think there'll be one that I anticipate will be a cluster of cross-collateralized vaults that just focus on stable coins, and another cluster that just focus on ETH-based assets like LRTs, LSTs, and ETH. There might be some more like exotic markets for long tail things, but in general, I don't see there being, you know, thousands of vaults with all that all have liquidity, right? Liquidity usually finds its way to places where it's sort of efficiently used in the way that people find useful.
Sure. So in terms of liquidity, then what sort of um, amount, like locked in sort of protocols built with this software would you be hoping for, in 6 months' time?
I have no idea. I think I don't. Yeah, it's difficult to make forecasts like that. I mean, there's billions of dollars in locked liquidity inside lending protocols in DeFi today. I think that number's actually small from where it could be in the future. I do think DeFi is a whole very good place to hold liquidity, and it means that capital can be used efficiently, and the composability of DeFi has lots and lots of advantages over traditional finance. So I think we'll see that overall number grow, and I would like to think that V2 is one of the best, if the best lending protocol on Ethereum, and so yeah, I'd like it to see it take a sizable share of that over the long term. But in the short term, I think the key thing is to just focus on users, listening to feedback, and making sure that things are safe and secure. So we don't set any goals really, apart from that.
Yeah, and talking of DeFi, a lot of people, maybe more traders, but a lot of people sort of, felt it's been in a bit of a bear market of its own for,
Mhm.
quite a long time. Do you think is it harder sort of building in that environment, and do you think DeFi can break out of that?
I don't think it's harder building in a depressed market. No, I think it's actually the best time to build for sure. There's nothing worse than being sort of sidelined. And also in sort of more active, vibrant markets, people that it can be harder to focus because you get a lot of feedback constantly, a lot of noise coming in. So actually, it's the best time to build, I think. Also, personally, I always slightly disagree with the kind of premise that DeFi is, really struggling. It's true that it's not growing as fast as it once was, but it's it's barely 4 years old as an industry, and I think if we'd rather than focus on the ups and then the downs, if we just like drawn a straight line from where we were when I started building Euler, which was basically zero, to where we are now, I think everyone would be filled with optimism and be looking, to the future and thinking, yeah, this is a really disruptive technology that's got the potential to replace some of the things we see in traditional finance. But I think because of what happened with all the kind of yeah awful mess of FTX and all the rest of it, I think people are still have a bit of a feeling of negativity about the industry as a whole. Yeah, I personally don't feel that, and I think it's maybe hard for people to see out there as well, the amount of development work that's happening in the background. There's a lot of innovation that's taking place behind the scenes, and I think that's going to connect DeFi and traditional finance more and more over the coming year. And that itself will enable us to start to see a bit more growth in the market, so the numbers will start going up. Again, I'm quite sure of that.
Sure. And what kind of innovation? Like, do you have any examples for projects that you think are doing really well in terms of what they're building and what they're getting ready to ship?
I mean, I think we all know that Uniswap V4 is coming. That's for sure. I think yeah, that's going to completely change the way that DEX markets work. I think credit markets in general are super important. They're like the liquidity hub for finance, and on top of those, that's where like today we don't really see much trading of real world assets. It's not very exciting to just tokenize a T-bill and then just hold it. Like why would you do that when there are lots of ways to access T-bills and all these other assets that are off chain? I think what becomes interesting is when you can tokenize those assets, but then create really efficient and transparent markets for them, where trading can happen 24/7 with a global community. And that doesn't really exist today, right? I don't think there are too many places where you can actively trade tokenize real world assets. And I think that's going to change either through innovations on Euler or other protocols. I know there are lots of efforts behind the scenes from other companies to make this happen. So that's what makes me optimistic about DeFi as a whole.
Okay, and coming back to Euler version 2, one thing I noticed is you said you want to introduce irregular asset classes, such as real-world assets, NFTs, IOUs. How does that work, and what are the big challenges there?
Yeah, lots of challenges. I mean, today Euler is designed to work with fungible assets, and most DeFi protocols are, right. So assets that you can exchange one for one, and there are lots of them. So most of the ERC20 tokens we know and love. But yeah, there are lots of, when we say irregular asset classes, usually mean things that are non-fungible. And I don't mean just NFTs like, pictures of monkeys and other things. I mean like actually tokenizing intangible assets. In the real world, when you take out an uncollateralized loan, people call it uncollateralized, but it never is. You're always collateralizing something, and it's usually your future income or certain freedoms or whatever. You're always putting down some form of collateral in form of a reputation that has an intangible value, but a value nonetheless. And I think tokenizing those assets is key to essentially bringing more traditional finance on chain. And that's what I mean about Euler being able to handle tokenization of intangible assets in the future. I think that way we can start to see different types of lending and borrowing happening on chain than we see today. Most of the lending borrowing today is purely over collateralized in sort of traditional sense. You put down $1,000 of Bitcoin as collateral and you borrow $600. But in the future, yeah, if we can tokenize more of these sort of intangible but nonetheless valuable assets, we can see a whole new markets open up for the industry.
Do you think reputation systems will be needed there? Because when it comes to, if you move away from collateralized lending, you're going to sort of need to have some reassurances, that kind of thing. Did you see that emerging?
Yeah, I don't. I'm deeply skeptical that just reputation alone is enough. Reputations are really hard to make non-transferable. There've been ideas about this, like can you have soul-bound tokens and things, but you can always transfer a private key. There's often a way to transfer something, and I think as soon as you have that, it's very difficult to allow it to be used as collateral, because one day a reputation can be worth X, the next day it's worth nothing. So yeah, I think realistically for certain types of markets to come on chain, there are going to have to be tighter links between on-chain activity and off-chain credentials, credit scores, and also the legal frameworks that enable off-chain credit to operate. Right, like if you take out a loan in off-chain with a bank, you have a certain obligations, and if you don't meet those, there'll be certain consequences. If there's no consequences for defaulting on a loan, then everybody defaults and nobody lends. So it completely dies. It just doesn't work. So yeah, there will have to be tighter links, but nevertheless, I think they will come. I think the benefits to being on chain are just so large in the long run that people will find ways to do this, and we'll start to see growth in that area as well.
Cool. And is there anything else in V2 that you think is important that we sort of, haven't missed or haven't discussed rather?
I mean, there's a lot of things in V2 that are extremely cool that I would encourage people to go and check out the white papers. We've released 4 or 5 different protocols, essentially modules in this modular architecture, and some of them can be used completely independently. So there are novel things there and how to reward certain markets. Things about fees, our Oracle system and Oracle dashboards will be released. All sorts of different ways to create new markets on Euler and to use those markets as well. The user interface has a really powerful batching transaction system, which has been extended from V1, and that was one of the things people really loved about the off-chain components of the system. So we brought that back. So yeah, I just encourage people to come and check it out and have a play and send us feedback.
Cool. And changing topics a little bit, what's your take on the new Trump-backed project, World Liberty Financial? We saw the news, I think, yesterday. There seems to be a reskin of Doe Finance that was also hacked,
Yeah,
back in the day. Yeah,
yeah.
what's your take?
I mean, what is there to say? I tweeted that I didn't expect to be going head to head with Trump this year, but here we are. I think it doesn't. I mean, clearly. I don't want to get involved in U.S. politics. It's not really my thing. But he's clearly making a big pitch to people. In the U.S. That's not. It's not obviously been the case that the Democrats are particularly friendly to this industry, and I think there's huge opportunities for that. That leaves a massive um, space, right, for Trump to go after voters by appealing to the industry. And I think it's part of that play, right, is to try to show that he's dead serious, that if he comes in to power in the election, that he will make changes and make be a lot friendlier to the industry. So whether or not the actual protocol is a good idea, I'm fairly skeptical, to be honest. I don't think forking protocols is good for the industry. I've talked about this quite a lot in the past, that I think it's hard enough to build a protocol yourself, as we know. We're an extremely talented team. We took security really, really seriously, and still had issues. And that's true of lots of talented teams in DeFi. It's a really ruthless market and very difficult to build in. So you really need to know what you're doing, and just forking protocols, especially ones that have been hacked, sounds like a bad idea on the face of it. So yeah, I wish them luck, but I think people should be careful. I think yeah, if Trump wants to build something, maybe he could come and build on Euler, because it's a great toolkit for people to build on.
Sure thing. And to be clear, it's being, as far as I know, built by the person who founded Doe Finance.
Right.
So it's yeah, it's more of just like bringing it back. I guess
Interesting.
you,
Okay.
I,
Yeah. I
I
missed
guess
I
maybe.
missed that bit maybe, but yeah. I mean, yeah. If that's the case, that's good. That's good to hear. At least that somebody who knows like what the code does is kind of in charge building it. That wasn't apparent from what I saw on the tweets yesterday.
Yeah, I guess they're like both projects are in a way on a similar path. Being hacked, coming back. Around now, one of them has spent like the last year or whatever like developing and building a whole load of new tech. The other is
Hmm.
sort of backed by Trump. Which one's gonna succeed?
Yeah,
Um,
we'll see. Let the market
yeah,
decide, I guess.
yeah. But to your point, it is a fork of Aave, as far as I know. So
Yeah,
in
I
itself, it is.
don't know the full details. I think they were kind of it was some kind of higher layer for kind of doing looping trades on top of Aave or something. So yeah, it's yeah, it'll be interesting to see. I mean, it's yeah how it plays out for them. But
Mm,
overall, yeah, it's not surprising Trump's making this big pitch given the state of yeah the politics in the US around crypto at the moment.
yeah. And do you think it's a serious project or a gimmick?
Yeah, I mean, it's hard to say without knowing the background of Doe Finance too much. It sounds a bit gimmicky, is my gut reaction, but I respect anybody that's really trying to build in this industry. Like if they really actually not just foking protocols, but trying to build things from scratch, it's really tough. And I think yeah, if there's some real efforts to innovate there, then I applaud that.
All right. And then what are the next sort of milestones or steps for Euler going forwards in terms of like over the next 6 to 12 months? Obviously, V2's out. Is it purely just helping people build? Are there going to be any incentives for people to build? Sort of how do you plan the next 12 months in your head?
Yeah, there's a lot of people reaching out right now asking about how to build their own products and lending protocols. We've already seen some more sophisticated teams that look like they've started doing that's already today, which is great to see. There's a few projects that are operating in stealth right now, which I know are already building on Euler, that we might see within the next 3 to 6 months, which are offering some really interesting new ideas about how things work that tie into some of the real world asset stuff we talked about, and offering new markets and things. So yeah, excited to see some of those kind of come to fruition at some point. Um, there's been a long-term ambition to connect Euler with a decentralized exchange protocol that's custom built to work with the modular architecture of the lending protocol. Uh, yeah, we've made no secret about this. So Euler Swap, we call it, it's been in development for a reasonable amount of time now, and that might be something that we see sometime early next year, I would hope. Yeah, in terms of incentives for building, I think the DAO's recently launched an experience points program. So there'll be experience points they come in seasons, but in season 1, experience points are allocated to vault creators, especially successful ones. So people that bring in fees for the DAO get more experience points. Yeah, there's experience points accruing to liquidity providers in ETH and USDC markets and all as well in season 1. So there are some incentives there for potential users, I think, that the DAO have voted to reward.
Cool. And that's all we have for today. I want to thank you for joining.
Yeah, thank you.
And then to everyone watching, make sure to give us a like and subscribe on YouTube, Twitch, wherever else that we are streaming. Remember, we have a 20% discount for Emergence, our first ever crypto conference, using the code TheCryptoBeat. And make sure to read the blog, stay informed on everything crypto. Thanks very much. I'll see you on the next one.